Hey everyone, welcome in to another daily editorial here on the KE Report. I'm going to be focusing in this segment a lot on the precious metals, but more so on the underlying stocks because, well, I really think a lot of the narrative around gold continuing to hold above 2100 and silver right around that $25 level. A lot of the technical factors are still the same. We need these continuation of higher prices to continue to keep moving some of these stocks, which broadly these stocks have also rebounded. I am chatting with Jordan Roy-Byrne, founder and editor of the Daily Gold. Now, Jordan, we are chatting on a Fed day. In all fairness, this whole week is full of central bank commentary, but again, it's a Fed day. We're going to see volatility on the back of the Fed announcement. We just had the Fed announcement and the start of the press conference, and hey, we're seeing some positive moves in a lot of sectors, including the precious metals. But Jordan, I know you love to ignore what the Fed has to say. I'll give you the floor briefly to at least address that.
Hey, Corey, thanks for having me on. Yeah, I don't know what the Fed said. I don't care. The reality is, if we step away, we look at the technicals of the market, everything in precious metals world is acting pretty well. Gold, we have this major breakout from this 13-year cup and handle pattern, has measured upside targets initially from the smaller cup and handles of 2350, 2500. The big pattern projects to roughly 3000. The log target projects to roughly 4,000. And so gold is in breakout mode. We know that after gold breaks out, usually a couple months, or it could be 9 or 10 months later, silver then breaks out and really starts to perform. So that's what the technicals are telling us. If we think about the fundamentals, it looks like we're in stagflation. We're headed for stagflation as the jobs market starts to get a little bit worse. And that's why the Fed's in a pickle, because if they hike rates, they're going to do a lot more pain to the bottom 50% of the country. And so they can't do that. And also it would push the economy into a recession. And at the same time, they really don't want to cut because the economy's holding up okay, and you have long-term inflationary pressures after they did all this hiking and tightening are still turning up. So they're in a pickle, and I think that's what, especially the chart of gold, that's reinforcing. And so, I don't care what the Fed said. It doesn't matter. They follow the market, and the market is, at least as far as the technicals, it looks really good for gold. And if that continues, which I think is more likely than not, more capital is going to move into silver. It's going to move into the gold stocks and the juniors eventually. So in this sector, we're finally in a really good situation. So because of that, there's nothing that the Fed can really say or do at this point to change that. They could affect volatility, short-term volatility, but aside from that, it's really not worth your time. You should focus more on researching companies and trying to pick the best stocks that can really move and make you a lot of money in these new bull markets. So thank you, Corey, for letting me riff on here about the worthlessness of following the Fed.
Hey, no worries, Jordan. And not that you care, but look, the Fed really held pat, and they're still projecting 3 rate cuts for this year, and that's giving a boost, as you said, to gold, silver, the underlying equities, as well as the U.S. equity markets. The S&P now above 5,200. Look, Jordan, let's get into the gold equities first and foremost, because we have seen a broad rebound in these stocks. Now, a lot of these stocks broadly off some pretty depressed levels, but we've seen at least a 20% rebound, I would say, in most of the stocks, and even more so on some of the on select other stocks. So, what have you noticed in terms of the gold equities that have rebounded? Which ones are performing better in your eyes?
The ones that are performing best and better, as you asked, I'm seeing the strongest growth-oriented producers, or just producers in general. You know that I don't really look at majors. I look at juniors and some larger juniors, and the ones that are the healthiest and have production growth potential, those are the ones that are performing the best. And it makes sense because those are the ones that are going to benefit from gold moving from 2000 to 2200, in at least benefit immediately, because that's going right to their bottom lines. And size is also an important factor. So that's not to say that a company needs to be producing 1 million ounces or 3 or 500,000 ounces, but if you have some size and scale and you're making money and you're well run, you're really going to benefit from the initial move in the gold price. And for the companies that are not benefiting, either they will benefit fairly soon if gold continues at 2350 or 2500, or there is something seriously flawed and that they're going to be the share price will be asleep for a long time or until something changes.
So when it comes to miners and their cost profile, does it matter right now if they're a low cost producer or a higher cost producer in terms of the potential degree of move?
Well, at least the ones that I'm looking at, they're performing best. They're lower cost producers. But if you are a higher cost producer, but you're doing fine running your businesses, you don't have any major problems. I think capital will eventually flow into those types of companies. It's just that initially capital is going to go into the lower cost producers that are growing. That's the way I look at it.
So when it comes to growth profiles, what are you looking for in terms of a growth profile? A lot of companies say, hey, look, we are going to be drilling, we're going to be exploring. We might either be extending mine life or they might actually have some sort of development going on the project to bring in a new area or install some new equipment that can ramp up growth in terms of production. What sort of growth are you looking for?
Production growth, essentially. I know that's what you were asking about, but I'm thinking about the next, 2, 3, 4 years, and I think production growth potential is the number one thing, and then the second thing would be, do they have re-rating potential or valuation expansion potential? If there's a company that's trading at 6 or 8 times cash flow, is there potential for them to trade at 10 times cash flow or even 12 times cash flow? So I'm looking at those numbers and assessing where these companies could be in, again, 2, 3 years, and maybe even 4 or 5 years in some cases. So it all comes back to production growth potential and what the company will look like, again, 2, 3, 4, 5 years. And again, it just comes back to the numbers. I mean, generally, if you're looking at a smaller company, you would like them to need to have multiple mines, or they have a mine that's, they're going to do a startup approach where they're a phased approach where, maybe they'll start out producing 70,000 ounces, but it could get up to 100 or 125,000 ounces, something like that. But also at the same time, I think if you're developing a really big mine and you're able to finance that without destroying your capital structure, those are also interesting situations where that type of company can, go from being a smaller company, and if they can successfully finance and build that much bigger mine, they can do really, really well, or I should say, the share price can perform really, really well. So, I mean, every situation is different, but I mean, it comes back to what's the re-rating potential and what's the production growth potential, and can they finance it?
So it sounds like growth, near-term growth is most important. Fair enough, to take advantage of higher metals prices. As you just said, though, some of that growth does need to be financed. Some companies look like they'll be able to do it through cash flow. Many companies are going to have to go to the market. How do you gauge if a company will be able to finance that growth? What metrics do you use to balance that question out?
Well, you have to look at their capital structure. You have to look at, what is their share price? So is it possible that they could do a big equity financing? How much cash do they currently have? Those are really the important metrics. If they don't have a strong stock price, then they may need a partner, or they may just not be able to get the financing that they need to build the project. So it's looking at, okay, how much do they need to raise? And also assessing, well, they're going to need to raise probably more than that, because if you're looking at these studies, even these studies from 2 years ago, those are outdated, and there's cost inflation on top of that. So whatever they need to raise to build these projects, they're probably going to need more, and then they'll need a little bit more than that for working capital. How can they do that? I mean, if they can they get a royalty? Can they get some debt? Is their share price high enough where they can do the raise? So those are important factors. But also the project has to, the economics have to be strong enough at, like, call it 1800 gold. So there's a lot of marginal projects out there that, maybe on paper they look good, but they're really not going to be financed unless, we see big moves in gold to 25 or 2700, which I think is coming. But that's also another important factor with all these projects. There's some that they're not economic enough. I mean, if it was, you had all this money to give to these mines, like, you're not going to finance these marginal projects where, you have to gamble on the gold price going higher. So there's all these different factors to look at.
Yeah, that's such a good point, though, Jordan, is that there are so many projects out there that could move into production. And yes, a higher gold price will help that, but there isn't the capital to move all of these companies into production. So it is still looking at some of the sensitivities to the metals prices for some of the ones that will actually get into production. That ties into the development plays then, because those are longer lead times. Some of the builds, well, many of the builds will take well over a year, if not a couple years to get into production. We've already seen some failures in terms of recent development. So are you going down into the development plays after you buy the production growth companies that you already like?
Well, I do like developers that maybe they're not producing now, but they're going to be building their mines very soon, and they could be producing gold in the next 2 years. If it's more than 2.5 years away, I mean, if it's 3 or 4 years away, that's just too far away for me. So with developers, I want to see projects that I really think this could be built in the next couple of years. I think that they can finance this project without destroying their capital structure. And then you have to look at the numbers. What kind of margin will this project produce? What is it worth now? And if it's worth a lot more now than the market cap, then that's exactly what you want to see. You don't want to see marginal numbers and, well, this will be better when it's at gold's at 2500. I mean, yes, everything will be better when it's at 2500, but you want to buy the better ones now that can be built and make it at 2000 or 1800 gold, because those are the ones, that's where all the money is going to go in the, first half or 2/3 of this new cyclical bull market. I mean, Rick Rule said developers, I mean, months ago, he said that developers were the cheapest that he'd ever seen in his career. Now, with respect to silver developers, I'm more intrigued by the optionality. I mean, just in general, I kind of like optionality a lot more with silver stocks and gold stocks. So I would be more willing to buy silver developers where, maybe production is 4 or 5 years away. We know that if we are in a bull market, that silver will move more than gold. And so there will be more optionality in the silver developers versus gold developers. So gold developers, I want to buy those because it's also a production play that's coming in the next few years. Silver developers, I'm more okay with something that is not going to be built for 4 or 5 years, because those have a lot more optionality, I think, over the next couple of years.
What about jurisdictional considerations? Because look, some of the most high margin projects are in, let's call them, lower class jurisdictions. How do you view the jurisdictional risk associated with some of these?
Jurisdictional risk now is a much, much bigger deal than 15, 20, 25 years ago. As someone told me, every jurisdiction is now worse than it was 20 years ago. I'm someone who generally, I don't weight jurisdiction risk that important. It has bit me a couple times in recent years, but I generally feel that you want to try and find the best projects first and then worry about the jurisdictions later. You don't want to pigeonhole yourself to, well, I'm just going to only look at North America and I'm not going to consider all these other projects. Look at the projects and everything first, and then assess the jurisdiction. One thing about jurisdiction is once the project actually gets built and it's making money, to me, the jurisdictional risk is so much less. I mean, it's making money, it's paying taxes, so you know that all the stakeholders there, that they're generally in favor, of the project being built because it just got built. So that to me is how I assess jurisdictional risk. I think by the time the project's built, I think it's generally less, and you have less concerns. Of course, things can pop up anywhere at any time. I mean, you really need to diversify yourself. I mean, if it's a risky jurisdiction, don't have a huge position in that company. But looking at everything around, Corey, like if you cut yourself off only to North America, I mean, you're missing out on a lot of great opportunities. So you really have to look at everything, and maybe jurisdiction can be the final cut. You don't want to look at jurisdiction first. I would look at it last, because I mean, you can always sell the stock, if it makes you uncomfortable, but you don't want to look at jurisdiction first and then cut out too much of the world, because you're going to be missing out, as you said, on a lot of great projects.
All right, Jordan. Hey, thanks for taking a look at some of the companies, what you're looking at in terms of the sector, because look, these stocks are still grossly undervalued to where the underlying precious metals prices are, especially the gold price. Everyone's waiting for that catch-up move, but sure helps to be in those stocks that can provide you the best torque to the upside. Jordan, again, is the founder and editor of the Daily Gold. I'll post a link to his website, and Jordan will chat with you again next week. I hope you have a great rest of your week.